An investor has to choose between an equity fund that has provided a return of 14% over the last 10 years and a debt fund that has provided a return of 5 to 6% over the last 3 years. The equity fund has a higher risk than the debt fund. How should the investor choose? The investor can choose equity given the high level of return, but the risk is higher, too. Besides risk, one also must consider other aspects, such as investment duration and investor's age and risk appetite. Equity investments suit young investors who can take high risks. Investors with long-term goals can also invest in equity funds. If the investor chooses debt because the risk is low, the return will also be low. In addition to low risk, investors can invest in debt funds if they are looking for capital protection, regular income, or achieve their short-term goals. Equity and debt mutual funds are essential for a balanced mutual fund portfolio. The best approach to take could be to decide on a percentage allocation to equity and debt. But making that decision on what might be the right proportion will require bringing in the investor's objectives, return requirement, constraints, and ability to bear risk. The solution to the above problem is not mathematical, but the choice an investor makes from a combination of risk and return for various proportions invested in debt and equity and other aspects.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.